Hello, everyone. Thank you for coming to our panel on fraud, identity, and building safer rails. We'll each introduce ourselves independently that way. I'm not just reading names. It'll be more interesting. So I'm Nick. I work at Stripe, and I work on a bunch of our crypto products and stablecoins and payments and just general money services business products and activities at Stripe. Bryce?
My name is Bryce Ferguson. I am the co-founder and CEO of Turnkey. Turnkey is secure, flexible, scalable wallet infrastructure used by folks like Polymarket, Moonshot, Magic Eden, and a bunch of other big names in the crypto space for everything from transaction automation to embedded wallets.
Awesome. Hi guys, I'm Paul Menchov. I'm one of the founders of Republic. I was our CTO, and now I primarily focus on crypto products over there.
Hello, my name is Jörn Lys again. I'm the founder and CEO of Bkey. Bkey is a global neobank based on stablecoin rails. Our technical differentiation is that we have a self-custodial wallet based on a technology that converts biometrics into cryptographic keys on the fly. And we have 19 patents in this space, and the unique part of our technology is that if somebody steals your phone, there's nothing to steal. There's no biometrics, there's no private keys, and there's no secret, with all the safety and privacy benefits that has.
Amazing. I'm Henry Stern. I'm one of the co-founders of Privy. We build user onboarding and wallet infrastructure so any developer can build on-chain products without having their users think about key cryptography or anything else like that. We power about 50 million wallets today for apps from gaming and social networks to neobanks and payments products.
Cool. I figured before we start talking about fraud and all the fun, detailed compliance things that go on, we could start something a little bit more fun and interesting and high level. And so my question for everyone, and I'll give you an example, like what's something that you're thinking about or just spending a lot of time on that could really change the world of finance, commerce, crypto? It doesn't have to be fraud. We'll ask you tons of questions about fraud. Like for me, I'm thinking a ton about how stablecoins and blockchains could actually change fundamentally how we do correspondent banking. So like right now the world runs on these network of banks with Swift, and like there is a low probability but decent probability that smart contracts and stablecoins might actually fundamentally change how bank networks work. And so that's like something like a pet project I think is kind of futuristic and interesting. Is there anything else that you guys are thinking about that's like just kind of cool, different, unique, and low odds but high craziness?
Sure, I can kick us off. One of the things that we've been seeing at Turnkey is this shift towards really high throughput machine-based transactions versus old crypto was you kind of buy and hold and you don't move your crypto that often. With that, having really strict controls around how those assets move is really important. I think a lot of folks have built policy engines in the past, but they have been pretty rudimentary and focused on what amount are you sending and to what address. Crypto is super open, super permissionless, and so we have been focused on how do we have a more programmable policy engine to think about all of the different types of transactions that you could be doing on-chain, policies around different smart contract calls, external data feeds that you can plug in, and then even more arbitrary code execution as part of that policy evaluation. So what we're excited about with that is just how this opens up the design space for these more machine-based transactions, whether it's payments or AI agents.
Awesome. So yeah, Republic started off as being a platform that enabled folks to invest in startups and under the new regulations in 2016 under the Jobs Act. So we've continued kind of down this track of making assets accessible. I think the tokenization of real world assets is a very interesting tool for doing that and is enabling that across asset classes. We're seeing a lot of institutional assets coming into the space with a lot of strong interest from folks like the Blackstones and Hamilton Wanes of the world to tokenize their funds, to tokenize those assets, and make them scalable enough for retail distribution. And so a lot of the work that we're doing and that I'm excited about is having that end-to-end flow of tokenization. So both the actual tokenization process, the primary issuance piece, and then the secondary trading piece, all regulated in the US, which is something that I think absent tokenization would be hard to do and scale with a lot of these assets.
Cool. One thing I been thinking a lot about this, the agentic future. So everyone is super excited about agents. And I think I'm excited about agents as well, but I also think that we are going to enter a world of pain once all these agents are going to go out there and access data, access credit cards, do procurement, and so on. So one thing I've been thinking about that I want to do, but I haven't come around to do yet, is to create a permission layer so that every time your agent is doing something, it is authorized. So an agent acts on behalf of a person. Sometimes it acts on behalf of a company, but there's also a person acting on behalf of a company. So then every time an agent do something, you biometrically sign an authorization and permission to do A, B, or C, being a procurement, with spending limits, etc., or whatever it is.
Nice. I think, like Paul, I've been thinking a lot about sort of how do you do end-to-end flows. If you think of stablecoins like an electrical circuit, like current-only flows, if you can actually close the circuit and have funds make it all the way to the end recipient or the from the purchaser. And so one thing that I've been thinking a lot about is generally all of the changes that are happening to NFC chips and access to NFC SDKs on mobile devices. So a recent hack that we built in-house for fun was just, can you turn any app that basically has an embedded wallet baked into it into a payment method whereby any user can actually just tap their phone against the puck and make a payment that way. And so I think as you see more and more happening with general off-ramping card issuance, the question of like what are the other modalities through which actually the payments loop can close is something that I think is really worth considering, because ultimately liquidity issues is kind of where the stablecoin story right now gets stuck in terms of getting to global scale. And so what are other means that we have for closing that liquidity gap is part of the question.
Everyone's super fascinating. Now we can get into the actual panel about fraud and compliance. I thought it'd be fun to start with something a little bit more like big-brained and high level, just to get people excited and thinking. So this question's for Paul and Jorn. How would you define the current landscape of fraud risks for stablecoins and crypto? And like, where do you see fraud most prevalent? And what are some areas that, if fraud's prevalent now, what are some futuristic problematic areas that could arise as the, whether AI occurs or not, or whether, crypto just evolves, like where's fraud heading? Well, I guess we'll start with Paul.
Yeah, I think it's probably a pretty wide landscape overall in terms of fraud and risk. One that is kind of near and dear and very familiar, I think, just starts with just KYC AML, identity verification and money laundering systems, and whether the historical standards for doing those processes actually work anymore. We, between Republic and another company I worked on, CoinList, probably KYC'd over 10, 12 million people in crypto specifically. And the amount of fraud there is huge, ranging from folks, rounding up folks in a third world country, in their town or village, and having them KYC on behalf of users and then selling those accounts for other folks to use, through to, obviously AI deepfakes now are capable of pretty comprehensive, forging of visual identity and liveness checks, through to the fact that pretty much every, U.S. taxpayer's private info has been leaked in one form or another through a credit bureau or some other hack. So we basically have these stale databases of information that are available to attackers. We have easy forging. And then we have a broader issue of the various attacks that are you're capable of doing in crypto land, whether that be masking funds through the more advanced ZK mixers now and all these pieces. So I think basically folks we have a lot of outdated systems that need to be modernized to Web3, and Web2 is basically going to be ineffective at this altogether. Web3 has the capacity to become effective at fraud and risk mitigation, but has to take on all the legacy issues of Web 2.
Yeah. I think there are a number of areas that we can be exposed for fraud. I think one area that will be much more vulnerable going forward is the whole KYC process. In a world where deepfakes can trick all of us, I think identity theft, identity fraud in itself is a massive problem. And when AI is going to be weaponized for social engineering and so on, we are just going to be in a world of problem, I think. I did mention it already, but I do also think that the future agentic world is going to introduce massive amount of vulnerabilities. And I think we are, I mean, to this day and time, we're not able to protect a credit card number. So when we're going to let loose all these agents, it's going to open up lots of vulnerabilities. So I think that's a lot of fraud. And maybe when I think about stable coins in itself, if there's going to be lots of stablecoin issuers, I wonder or maybe worry about the centralized vulnerability of stablecoins. So how well is this collateralized? How do you make sure that nobody just takes the fiat and runs with it? And also, that people don't just burn their tokens and run off, right? Yeah. Stablecoin are really not distributed and non-trustless in a way that normal crypto tokens are. So I think that is an area for vulnerability as well.
Yeah, and adding on to that, I mean, we have in the U.S. the Genius Act making its way through Congress to try and regulate some of this. And while there isn't, that decentralization of those things, trying to provide some framework for the centralized transparency, the issue is that I think retail users are not going to recognize that these things are not all built the same. Specifically, the bill does have different, rules for sub $10 billion stablecoins and above $10 billion stablecoins. The sub $10 billion ones, defer to state regulators effectively in a lot of ways as to how they regulate it. The assets that underlie these things are not tracked and audited in the same way, whereas the larger ones are. So I think we're going to have a lot of user confusion potentially in this space around what are, they think it's all, good gold standard treasury-backed stablecoins, and in reality, it might be dog shit.
Makes sense.
That's a technical term. I was saying that was a technical term for us.
Yeah, that is a crypto insider term.
All right, I wrote the questions. My favorite question that I wrote is this following question, because I think a ton about it, and I actually think there's a lot of real-world questions to figure out how before I ask this. So how do you guys think privacy will evolve on chain? Like, we have things like as basic as wallet rotation, and we have like abstractions, people trying to wrap tokens or build things on top of tokens and abstract away and build privacy on top of all of it. You could have privacy chains. There's all these different views of privacy. And like, what role do you think privacy plays, C to B, B to B, B to C? One of my things is like, if crypto is going to fundamentally change funds flows, like you need to be able to at least protect those flows. Whether businesses don't want other businesses to see their invoices, consumers don't want they don't want my friends to see how much money I have, and so it's a really fundamental question in crypto. So we'll start with Bryce.
I think this is an interesting one because regulators have truly beaten down the crypto industry to stop talking about privacy. You have Zcash and Monero that have been delisted off of every single exchange. The EU just announced recently that they're shooting to ban all privacy coins by 2027. South Korea and Japan have banned privacy coins. And it's one of those things that people have just kind of stopped talking about it in as big of a way as they used to. But it is still so important. I had a friend recently who made his first trade on Uniswap, and it was his first time interacting with crypto, and he looks at me and he says, "What do you mean that if I give my address to someone, they have all of my financial details?" And the concept, if somebody came up to you and said, "Hey, can I see your bank statements?" You'd be like, "Absolutely not. Like, no way." And that has just become the default in crypto. And so I think the unfortunate reality is we need to find ways to work really nicely with regulators because frankly, there are good reasons behind some of this regulation to avoid money laundering and criminal activity. And so we see interesting folks trying to innovate in this with ZK and other kind of selective disclosure in privacy. And I think that feels like the direction things will go of, hey, how do you work to avoid bad actors in the space, but still have broad privacy for most of these use cases? Because it is just fundamental to mass market adoption for both consumers and businesses.
Jorn, what do you think?
Yeah, I completely agree with that. I think privacy is an absolute necessity. I mean, it cannot be that people can ask you, what balance do you have in USD, crypto, or Bitcoin? I mean, it's unheard of, right? So for this to actually really fly outside of the hardcore crypto environment now, we need to have privacy. And when it comes to stablecoin, which is not really which is kind of centralized anyway, I wonder if private chains might be a way to solve it, right? That rolls up maybe layer 3, maybe bases app chain, so it rolls up and so on. So it will be then private. People can still audit it, but it had also the benefit and the functionality of a blockchain.
Henry, your mind looks like it's turning, so
Yeah,
you got the mic.
one thing to add here, I think that we've seen play out interestingly. I'm generally, I think, unfortunately pessimistic about both, I guess, stated versus revealed preference of how much people care enough to act about privacy. And then I think the way the world has gone through the internet is if you care a lot about privacy, you just deal with like subpar products. You stop using Facebook, you give up on things that other people get to have because privacy is not supported. And I think the question of like, are we defining privacy as a consumer feature or as a B2B feature is an interesting one. And I think one thing that gives me hope through conversations we've been having with large global businesses basically that are having sort of networks of funds roll around across countries, across merchants, across customers, is that they care about privacy because they don't want the entirety of their financials as a public company being leaked to the world. And so maybe, I don't know if this is like defense against hedge funds or probably like just trying to protect our merchants or whatever it is, but I think privacy as a business requirement for folks coming onto stablecoin rails, I think business-led is actually a likely path for how we get a lot of broad adoption of the ZK tooling and other things that we've been developing.
Is that because you're connecting privacy and security in the business context, but not necessarily in the consumer context?
I think so. And then it's like the aggregate power. You've got a few companies that are big enough that like L1s will roll over to give them their product requirements, whereas like a loud chorus of individual consumers who don't all have the same words to express the fundamental need that is so nebulous, as it were, aren't powerful enough to move the needle.
Yeah.
I like your point on the hedge fund. Something I think a ton about that people don't talk a lot about is like if a publicly traded company were to ever use crypto, they have actual rules around data. And before quarterly reporting comes out, and hedge funds are notorious for like finding satellite data to predict like supply chain issues in companies, then take positions. Like, what if a hedge fund could figure out your various wallets and your various inflows and outflows? Like, not only do you have a real privacy problem, but you have an actual like business requirement reporting problem potentially. And how do regulators, change their view of these things as things either move on chain where there's less privacy, or do chains move towards a more private world? Like, there's a lot of really interesting implications that I think we're far, far, far from.
Can I also okay.
I think trading often does push things forward. And so I completely agree, Henry. Businesses finding economic incentive or business incentive are going to be the ones that do it. It also does feel like trading has a big opportunity to push this forward because nobody wants to have their trading strategies completely public, and that's how it works right now as well.
Yeah.
I'm curious, does anyone know how this has affected somebody like a Coinbase who is public and does have visible wallet flows? Or are folks actively trading on that information? I would assume yes.
I would assume that.
Yeah.
But I would think maybe one additional comment on this is like, maybe this is more of a European viewpoint. So I remember when I came to the US in 2005, everyone said, privacy, forget privacy. Now it's all about transparency, Facebook, social media, etc. And as a European, that was outlandish. And thank God for Cambridge Analytica, because suddenly people are like, oh, maybe we should think about privacy. So there's something in me that react negatively when we hear, oh yeah, from a business perspective, we need to protect businesses. That we need to provide privacy for businesses so that people cannot trade on their stock. But I think that the social responsibility we have for individuals and protecting their privacy, I think is as important, maybe even more, because they're more vulnerable than businesses.
I agree. So I did C2B, B2B, and B2C. I covered all my bases of all the various variations and derivatives of privacy. So we talked a lot about privacy. That was actually really interesting, and I'll probably talk to you guys more about that like once we're done, because I'm so curious. Some other questions around it. But moving on to the panels, the rest of the questions. So Bryce, Paul, and Henry, this one's for you. As more people move on chains and move on to stablecoin rails, and businesses either build natively on it or incorporate into their existing business, like how do you guys think about usability and like the classic term, like if our parents can't use crypto, like we still have a long way to go. Like what are you guys doing in your respective companies around usability, and it can be anything from UX all the way down to just general like ease of onboarding to just like even how you explain the product functionality, which I think is out way beyond UX and way more fundamental. Like how do you educate people of what's going on behind the scenes of a wallet, like transaction signing? Like what does that all mean to a person that has never experienced this before? Bryce, we'll start with you.
Yeah. My spicy take is the building blocks of good crypto UX are in place. And the bigger problem is how do you actually put those together in compelling products that are 10 times better than our existing financial services? You see crypto taking off in places that don't have compelling financial service systems, and not as much in the US, where you can go take your debit card and tap it at any merchant in the world. So one of the things that we think about at Turnkey is how do we make experimentation with those building blocks as easy as possible, to try to innovate on the overall package that you're taking to market and iterate very fast on that. I think some of this also comes down to network effects as well, where crypto does need this connective tissue throughout the existing financial system, as Henry was saying earlier, to be able to use your crypto at a POS terminal. So yeah, I think a lot of this, we are in this position for a Cambrian explosion of innovation from a UX perspective and actually compelling products, because those UX problems have been solved in large part.
Yeah. And in large part, I think thanks to folks like Bryce and Henry, because when I was building a lot of this stuff initially at Republican CoinList, that stuff didn't exist, and the APIs for a lot of the secure kind of operations that you'd want to do, and the capacity for a user to take on self-custody meant a necessary UX trade-off that I think is now diminishing over time. But I think speaking more to the kind of broadly UX in the space, not necessarily too specific to stablecoins. I think a unified API, which is what I kind of look at the blockchain ecosystem as, is broadly a means of unifying a user experience. So right now, if you're trading, equities and commodities, you're going to be doing so on two different things. You might be trading on CME over here and NASDAQ and NYSE over here. Each of their matching engines might have different properties. There's all sorts of variances that occur between asset classes, between venues, that get normalized over time as we build these building blocks that are, fairly standardized and can be replicated across. Even if you have a different chain, different authoritative ledger, you still have the same kind of mechanisms. So I think that increased uniformity allows for the thing that I was saying I think a lot about, is how do we get folks investing in interesting alternative assets that weren't available to them before, and part of that is making for a consistent user experience in their doing so.
Maybe I'll go very bottoms up in terms of where the gaps that we see remain, both as part of consumer experiences and developer experiences. In large part, I completely agree. Like all the pieces are there. To Bryce's point, I think it's about finding the right ways to put them together, and then I think a few like very charismatic use cases will kind of lead, and people will jump in after them. Broadly, I think that the places where there's still a lot of work to be done. One is on call it 4x, which is the number of tokens and chains out there make it very hard for people who have liquidity to actually find places to spend that liquidity if the platforms they're on don't speak the same language. So this is baking swaps, exchanges, bridging much more natively into product flows for both, for example, developers that we serve at Privy, but the end user as well. I really honestly could not care less if I'm using USDC on Solana or Base, or in fact, if I'm using USDC or USDT, as long as the asset, the dollar that you've told me I have, I can actually spend with this other person who can receive a dollar. And the fact that that today is still horribly complicated is probably a big remaining gap that really sits at the infrastructure level, less about UX. And then I think gas, in spite of how well understood a feature of these systems it is remains far too hard to like estimate and handle. And so just in practice, we see probably tens of thousands of transactions on a monthly basis revert because gas hasn't been set properly. And having to tell a developer you can basically pay up and not think about it, or you can try and be clever and just like risk failing 30% of the time is not a great sort of guarantee for a financial rail. So those are the areas that I think we're looking into, and how do we keep getting the polish to a point where you don't even have to think about the infrastructure that you're running on.
Something that perplexes me is you still have to, in a lot of wallet UXs, like look at the tiny little icon at the bottom to see which chain it's on. And you're like, how do I get that off the chain to a different chain? I got to go to a different, I got to go to a DEX or something, or a different part of the wallet to then get it off. And you're just relying upon these like subtle nuances that like 99% of people have no idea. And you're like clicking buttons that you barely know if they're going to work, or if you're about to lose all your money, if you're going to get the money back. It has a long way to go, I think.
But then conversely, I was in Kenya over the winter, and I saw real preference for like Tether. Tether is a better dollar, literally, than your other dollar. And so on the flip side, I feel like there's some like actual trust being built around individual assets that people are.
I buy that. Assets are having consolidation, but chains are still very sporadic. Like I think that's kind of, I feel like we see the same thing time and time again, which to your point, like if you could just make chains it's just a network, doesn't really matter what chain it's on, is probably like 99% of the problem that exists anyway. And you guys can, as wallet companies, you guys can monetize that, right? That's exciting. How do you make money? You can monetize the transactions out, in and out. That's very fun. So the second to last question is for Henry again and Paul. Preventing fraud in stablecoins is going to require a lot of cooperation. There's public entities like regulators, and then there's private stakeholders like the issuers of these stablecoins and the exchanges that people typically get them from. Like what partnerships and forms of collaboration do you guys see as key to unlocking adoption? And then my part two that I just thought in my head right now, but I'm curious, is where do you see the role of issuers playing in terms of just like, stablecoin? I don't know, it can be anything from stablecoin compliance all the way down to like, just general like ecosystem development of their various stablecoin. And to your point, Tether versus USDC, like what role do you think the issuer plays in the global adoption?
Yeah. I mean, I think transparency is probably the biggest obligation onto the issuer, and a transparency of the reserves of the asset and a constant publishing. I think the regulation stating you to do like a once a year audit or something, I mean, that's not enough, obviously. And there's no reason why, when we have a live system that is, has a clear record, we couldn't publish continuous kind of Merkle proofs of reserves and whatnot. Why we couldn't build in automated kill switches, if the reserves don't, show that the more can be minted, more should not be minted. So I think, we're inheriting the legacy issues of Web 2, but we have, I think, the new kind of capacity to implement some of these automated safeguards, to have privacy-preserving, things like KYC, which also limits the exposure risk of, leaking that underlying data. We have obviously now, improved biometric capacity for liveness checking and whatnot. Hopefully, we can stay ahead of the deep faking on that. And I think there's a lot of room for international cooperation and, information sharing, standardization of travel rules and whatnot. A lot of buzzwords in there, but we can double click on any part of that.
Maybe the way in which I try to think about it as well is like, if you look at like fraud and sanctions, they're like two sides of a coin in terms of assets getting to places they shouldn't be. And so there's a question of how much of that, or where should that be enforced? And I think if you look, there's like, I guess the issuer, the exchange, the sort of orchestrator, on-ramp, off-ramp, which is maybe another flavor for an exchange, but at this point they have a few different faces, the wallet, and probably a couple other venues. I think having, I mean, USDC introduced the kill switch that allows you to potentially, actually turn off the token. I think having the issuer have enforcement rails built in is interesting. And maybe the thing I'm looking at is how does the interplay between, call it, MiCA, the Genius Act, and various regulation across different poles in the world kind of come together. Because ultimately, if these are to be global like financial rails, then the actual regulatory means through which sort of the state's will is enforced through them have to be sort of uniformized across the world. Yeah. So this is a very long-winded non-answer, but I think like basically where do you apply power, and how do we get that application of power to be consistent across borders when it's different governments at the helm? I think the two things I'm watching, but it seems like a lot of concentration is happening at the issuer level right now.
Yeah, I think some of that we may see driven ultimately now by defense concerns. I mean, we've got DARPA, I think in January, put out a challenge demanding proactive KYC, AML, or rather AML, as a national security concern, given that half of North Korea's nuclear program is funded by money laundering and hacks like Bybit. And there is a now national security need for preventing some of that flow of funds, which I think will drive some, if U.S. history is anything to go off of, will drive some standardization across other areas of the world.
I think it's actually a really underrated point, which is like, the U.S. has, and every country has different types of power. They have like qualitative, like subtle power, diplomatic power. They have military power and they have financial power. And I think like under these new economic systems that are crypto and blockchains, like financial power is going to be very different, but also is going to be like, I don't think people really figured out like how do you impose that kind of like financial power, if you wish, under this new thing where it's more internet based, it's more digital, and it's a lot harder to control the flows of your currency when people have open access. And so I think it's going to be a really interesting shift for governments to think about global influence.
And I'm curious, maybe just as a survey for the panel. I mean, the U.S. imposed a lot of these kind of constrictions in the past with things like SWIFT and whatnot, where they basically set the rules, and we've seen that the U.S. lose trust, in fact, because of how they've manipulated some of those rules in the past. Does the U.S. take as aggressive a stance of trying to impose these rules now, or do we have a diminished capacity to do so given the openness of these systems?
My feeling is there's definitely a diminished capacity to do so, because you can always self-custody your crypto. There are going to be a lot of international platforms that people can bring their keys to, and it's going to be hard to prevent U.S. customers from using those completely. It won't stop them from trying. And so I think things could be messy along the way and could put a lot of challenges in the face of the growth of crypto and frankly, these non-custodial platforms that people rely on.
I completely agree on that. But maybe what we will see, if there are certain stable coins that are very popular and very important, that are domiciled in the US, they are exposed for US sanctions. So I think there's a reason why Tether is so popular.
Yeah, I was going to say, is that why it's so popular?
Maybe I'll take the reverse. I think I broadly agree, but for the fun of it, I'll take the other position, which is I wonder how much this is a difference in degree versus a difference in kind with regards to the power that illicit actors have to drive currency. Like, I forget the exact stat, but I think an incredible amount of cash being printed by the US Mint actually leaves the country immediately upon print. And it's something shocking. It's in the high double-digit percentage points of like cash that basically never makes it to the U.S. market for actual spending domestically. And so the reality is, if you want to enforce sanctions against a given currency, how do you do it? Well, you get all U.S. business in a world in which these assets are broadly used because they are a more efficient means of payment. You broadly get any U.S. retailer to stop taking it. Get Walmart to not accept USDT, and that's a very good incentive for USDT to fall in line with the Genius Act. And so. And that broadly limits the ability for whoever you're trying to sanction to get their hands on it, because there are fewer people to scam, to fish, to social engineer into giving up their assets. So certainly as a independent money rails that you can have, as long as you've got one exchange that's willing to do the swap, then you will always have the means of moving to a sanctioned token or geography. But I actually think the U.S. still has a ton of power, and I say this as a Frenchman, I guess, and looking at what Mika's done for at least clarity. I think it is much easier to operate around self-custody if you're serving, in our case, European, British, but like basically Mika domiciled business than it is to serve a customer in the US who has no idea exactly where the rails are. And so I think the US is still super, super powerful in this regard in terms of setting the social norms. Yeah, any system can be contravented, I guess.
I think the U.S., I agree with that. I think the U.S. is still powerful in the future, but I also think if there's one thing I know about the government, they have typically the best cryptographers to ever live. A lot of these things started out of DARPA. I'm sure they're going to think of really creative ways to ensure that the cards fall where they want them to fall. That's kind of my take on it. Like, our government is full of really smart people, even if we do say it's inefficient. A lot of the best scientific projects kind of originated, government projects. The last question for Bryce, Jorn, and Henry are, so on and off ramps are kind of becoming I feel like they were really popular, now they're maybe verging on buzzword. And now in the latest, in the last 6 months, people are kind of talking about like, how do you get into crypto easier or get out of crypto easier? And more importantly, how do you connect to the local rails? And maybe treat crypto like a intermediary technology. And I think there was a world where people used to say, oh, crypto will replace the financial system. Now they're saying it could complement it. So in the world where we assume it complements it, and there still is fiat and local currency, and there still are KYC, KYB, and transaction monitoring in the fiat world, like, are there ways we can leverage those systems, those traditional financial institutions, to like make on-chain transactions easier, cheaper, even more frictionless? And how do you guys see a world where like there's crypto concepts like on-chain monitoring, and there's like these traditional concepts like onboarding to a bank and doing like KYC via papers? How do you see like that blended world in the future where there's two very different systems that exist? We'll start with Bryce.
I think it's maybe not so much that they're going to coexist forever. I do think eventually crypto will supplant the traditional financial system and just be used under the hood for everything. But the bigger thing is, it is this opportunity to have the true mass onboarding of consumers into crypto, because all of these fintechs have really massive user bases and have built out kind of the tooling to reach the masses. So I think that over the next couple of years, it's going to be the true hockey stick growth of people, in particular using stablecoins, because I think that's what we're seeing has the most product market fit of just better financial services, especially in a global sense.
Jorn?
Yeah, so I think I will try to answer the question slightly different. So I think KYC and all the things that comes from fiat needs to be hardened even further. And when it comes to crypto and everything that we go about to enter, we just completely need to abolish username and passwords. As a minimum, we need passkeys, but I actually think we need biometrics. And I'm not saying that only because of BKey, but I think you need to actually, every time you access assets, you need to prove that there's a live person in front of you and it's the right biometrics. Whether it's Face ID or whatever it is, I think that is the bar we need to set. And when you do that, fraud, identity theft, and all these things will be kept to a minimum, and we can leverage all the benefits of crypto in a completely different way, instead of being derailed by all the frauds.
I might actually contribute by flipping the question. I think only one person on stage works at a company that's built on-ramps, KYC, KYB. Like, you guys launched international money accounts that do USDC and fiat. Like, what are the big hurdles that you guys are seeing trying to build these systems for non-crypto native audiences?
Okay, I wasn't prepared to answer my own question, but I think about this all day, so here we go. I think off-ramps are like just fundamentally unsolved. And I think a lot of people do want to hold stablecoins, and they will want to, and that'll grow very quickly, exponentially, and all those great things. But at some point, you'll always have to get back to fiat. And maybe not, maybe right now it's 90% you give back to fiat and 10% you hold in stablecoins. In the future, it's 50-50, 60-40 stablecoins and fiat. But, supplanting fiat is a tough task and might never happen. Even if it doesn't, you want to have the interoperability between the two worlds. And I think like off-ramping in local markets where stablecoins are popular is currently really, sometimes near impossible. But in general, just getting out of crypto feels challenging even in major markets. And I think like they're tough businesses to build. You got to go country by country, which I think is why no one's like just solved it globally. But I think like there is a lot of value to be had in that kind of country build. And I think like if you look at banks that have really kind of risen in the last 250 years, like Goldman, Citi, some of these banks are hundreds of years old. Or they may be 100 years old, but they had a version before it. Like they did do the country by country play, and that's how they got so big. I think we have technology now, so you don't have to literally go maybe country by country physically, but the idea of like setting up this global network per country, per corridor, like I think you can speed up with modern technology, but you're still gonna have to do the legwork to get that network built. And blockchains are accessible globally, but to get out of blockchains, it still requires like deep local thought, product, and compliance. And I think it'll be like a very, very interesting, but also well-funded area in the future as people start to realize more and more that piece is like the last piece that's kind of missing before I think you start to get true interoperability between fiat and crypto.
Do you think that happens just by virtue of local startups building that component and taking the rest as a kind of modular plugin? You got the big unified network, and then you just need to localize.
I think there could be startups, and there are startups doing this today. There's a lot of startups doing this today that are trying to go one by one. I think, there's a non-zero chance the banks start to participate a lot more. So a lot of the banks are publicly flirting with blockchains now. Some of the banks have had private blockchains for a while. Like some of these banks have, 100 country kind of local payout rails that they use for, B2B or their trading clients or whoever it is. Like they have these rails that aren't tuned to crypto, but they exist and could be retuned for stablecoins. And I think it's like, partnering with these, I think companies might try to partner with some of these banks to try to retune those rails. And I think as Genius Act things happen and regulation gets more clear, Mika, et cetera, like some of these banks I think might see a lucrative business opportunity to kind of retool some of their rails to help, kind of stablecoins and crypto percolate more globally. And there could be a really crazy harmony between crypto and TradFi that exists ironically in a way where they both kind of end up working together in the long run. We have 2 minutes. I left time for questions. If anyone has any. If not, we can call it. But any questions?
You got one over there.
I'll repeat your question for the room. Oh, amazing.
With older traditional TradFi, as we call it. Do you think that will eventually come to the death of like penny testing and other types of account funding and more movement towards like digital identities that are used across all financial institutions?
I hope so. I mean, the more that we unify on something like biometrics, where there is a spot test of identity rather than basically, I mean, the way traditional identity verification works is you have a database and then you ask people questions and see if their answers match your answer bank, which is, I mean, a pretty obviously flawed system. Any high school teacher that's ever written, a test has probably gotten that leaked and had students cheat on it. That's basically what's happening with KYC. So I think you get to, the supportable identity model when you do that liveness checking rather than having this answer bank.
I think somebody, there's a consortium of banks. This is from a tweet, so it's very good information that I'm giving you, that I'm not sure I read the tweet right. But supposedly, there's a consortium of banks working on a stablecoin initiative. And somebody brought up the comparison of this is kind of like Zelle 2.0, and Zelle is processing like $1 trillion a year. So not bad for an attempt at taking on Venmo. I think the fear is that this is such a massive market that there are enough good alternatives that you end up with your 3 identities, and they are broadly interoperable, but in a federated manner amongst participants who have agreed to like the balkanization of your global identity. So that would be the, I think, likely and unfortunate outcome to this, which is yes, but it's not the one, and it's not the one you control. It's the ones that you've subscribed to by virtue of the sort of core players in your life, the sort of healthcare provider you work with, the bank that you work with, and the massive marketplace you shop at, be it online or on the ground. And so I think figuring out how do we actually get the powers that be to coordinate and standardize is really important. And I would argue this is like maybe the time to rush to field. Like to Bryce's point, that the hockey stick is coming. We have a massive opportunity to actually like create those standards right now, and it'll become much harder as you get like massive liquidity pools that are disparate. Right now, USDC has an unholy amount of power in terms of like American money flows that could be used for this end.
We're at time. Thank you guys so much. I really appreciate you guys coming on and entertaining my random questions I thought through like kind of last minute, but hopefully they were helpful for everyone to listen to.
Thank you, Nick.
Thanks, Nick.
Thanks, everyone.